You've probably been here, watching your account balance bleed out, praying for a 10-pip reversal that simply refuses to arrive. Look at this flowchart of the classic martingale strategy. The logic seems airtight at first glance. You lose a $10 trade, so you bet $20. If that loses, you double to 40, then 80. The math dictates that eventually you have to win, and when you do, you recover all previous losses plus your original profit target. This entire loop relies on the gambler's fallacy. We are biologically hardwired to look at a sequence of 5 red candles and assume a green reversal is statistically due. The math of doubling down absolutely works on a theoretical whiteboard, but in practical application, it carries a fatal flaw. Executing a true martingale sequence requires you to hold an infinite amount of capital. In the 2026 foreign exchange landscape, you don't have infinite capital, and the market doesn't care what you think is due. Algorithmic trading and central bank digital currencies create massive vertical price trends. A single move on the USD/JPY can stretch 5 standard deviations beyond the mean, running for days without a single meaningful retracement to let you out of a bad trade. External macroeconomic shocks compound this danger. Sudden shifts in global trade policy, like the implementation of aggressive new tariffs, generate massive high volatility events. During these spikes, broker spreads widen significantly. A 2-pip spread can instantly balloon to 10 pips, aggressively eating into your remaining equity every time you double your lot size. Even if your stomach can handle the drawdown, your broker provides a hard mathematical ceiling. As your lot sizes grow exponentially, from 0.1 to 0.2 to 0.4, your margin requirement explodes. By the 6th or 7th loss in a sequence, a standard retail account will hit an automatic margin call. This exponential drawdown is exactly why modern prop firms explicitly ban the martingale approach. Firms adhering to the strict new FTMO and Awanda standards treat aggressive risk profiles as a massive liability. Doubling down to recover a loss will almost always breach a firm's hard 4 to 5% daily loss limit. Operating in a high volatility environment with hard capital constraints means the traditional double-down approach is no longer a viable strategy. It is guaranteed professional suicide. If averaging down is about chasing the market to prove you're right, the alternative is letting the market prove it is right. This is positive progression, widely known as pyramiding, where you only increase your position size after you are already in profit. This chart shows the mechanics in action. Let's say you open a standard long position on the UR/USD. You set a strict tight stop loss, risking only 0.5% of your total account. The critical pivot happens when the price moves into profit. Instead of closing the trade, you move your initial stop upward to lock in that gain. Only then do you add a second, smaller position. By stacking multiple scale-ins during a strong trend, you build a massive overall position size. But because you are constantly trailing your stops behind the price action to protect the accumulated profit, your net risk remains near zero. Once your initial trade is at break-even and you've scaled in, you are entirely playing with the house's money. This simple mathematical shift removes the psychological stress of defending your base capital, allowing you to patiently manage a growing windfall. This graphic directly compares the drawdowns of both strategies, measuring your statistical risk of ruin. The martingale equity curve is terrifying. The losses are vertical and exponential. The anti-martingale curve, however, is linear. It looks like a steady horizontal line with tiny, strictly capped micro-dips representing that initial 1% risk. In a market characterized by long periods of low volatility, followed by explosive breakouts, anti-martingale traders take minor, controlled hits during the chop. But when the breakout finally happens, they catch the entire length of the move, generating a massive upward spike that easily recovers 10 to 15 small losses at once. This capped risk math gives you a distinct statistical advantage in funded environments. You can comfortably hit a firm's 10% profit target by exploiting a single trend's momentum, all without ever threatening their 5% daily loss limit. When you analyze the raw probability of the risk of ruining, the data is definitive. Scaling your winners is the only mathematically viable path to scaling funded capital. But understanding the math behind this strategy is the easy part. The actual barrier to entry is entirely biological. We are wired by fear to take our profits too early.
Watching a large, unrealized gain fluctuate on screen triggers immense anxiety, making manual pyramiding incredibly difficult for a human to execute consistently without panicking and closing the trade prematurely. This is why the top tier of funded traders have adopted the Centaur approach. By integrating advanced MT5 scripts and FXNX automation, they completely remove human hesitation from their position sizing. These AI integrations constantly analyze real-time market volatility. By reading metrics like the average true range, the algorithm instantly calculates the safest, optimal lot size for your next gallon based on current market expansion. As the trend develops, the algorithm automatically trails a stop-loss basket for the entire group of trades. The machine manages the cold, hard math of risk, leaving you free to focus entirely on dictating the overall market direction. Surviving the volatility of 2026 requires strict emotional discipline. You have to protect your core capital aggressively while trusting automated systems to scale your winning trends flawlessly. Build a sustainable career rather than gambling on a single trade. Download the FXNX Anti-Martingale position sizing script for MT5 today and start a 14-day demo to practice automated scaling without risking a dime of your own capital.